Welcome to the Explainer. Okay, so let's talk about a tricky problem every company faces. You know, those big issues looming on the horizon, a potential lawsuit, a product recall, maybe a future environmental cleanup. How on earth do you put a number on something that hasn't even happened yet? Well, that's exactly where IAS 37 comes in. Think of it as the global rulebook for taming financial uncertainty. So here's how we're going to break it all down. First, we'll look at the core problem itself. Then, we'll get into the two main tools accountants have in their toolkit to deal with it. After that, we'll walk through the specific rules of the road for making the right call. And we'll wrap up with why all of this is so crucial for understanding a company's true financial picture.
All right, let's dive right in. First things first, why do we even need a whole set of rules for problems that are still in the future?
I mean, this is really the million-dollar question, isn't it? If you're a car company, you know you're going to be paying for warranty repairs down the line. If you're a big firm, you might be facing a lawsuit that could go on for years. You can't just stick your head in the sand and ignore these things. So what do? How do you report them honestly?
The reality is businesses are swimming in this kind of uncertainty every single day. And we're not talking about small, everyday costs here. We're talking about massive company restructurings, huge obligations to clean up environmental damage, or incredibly expensive legal battles. Each one of these is a potential major drain on the company's cash.
So, to get everyone on the same page, the accounting world created IAS 37. It's a framework that makes sure companies everywhere are reporting these fuzzy, uncertain liabilities in a consistent and, most importantly, transparent way. This is huge because it helps prevent companies from hiding big looming problems from their investors. Okay, so what's the first tool in the toolbox for dealing with all this uncertainty? It's something called a provision. Now, I know it sounds a little technical, but the idea behind it is actually pretty straightforward.
So here's the official definition. The two words to really focus on here are liability and uncertain. A provision isn't just a wild guess. It's a real, genuine liability, something the company is already on the hook for. The only parts that are a bit blurry are exactly when they'll have to pay up or exactly how much the final bill will be.
This car analogy is absolutely perfect. Think about it. The past event that caused this whole thing, that's just the normal wear and tear on your car. That creates a present obligation, without a doubt, that you have to get it fixed. And even though you don't know the exact cost to the penny, you can make a pretty reliable estimate. You're creating a provision. But what about situations that are even foggier, even less certain than a provision? Well, for those, we have something called contingencies. And these really are the true what-ifs of the business world. This is such a great way to see the difference. A contingent liability is only a possible future cost. It's like knowing your old car is getting up there in years and might break down, but it's no sure thing. On the flip side, you have a contingent asset, which is a possible future gain. The best analogy for this? A lottery ticket. You might win, but you definitely don't start spending the money before your numbers are called. And that quote really gets to the heart of it. Accounting standards are fundamentally conservative. You always prepare for probable losses, but you absolutely do not book potential gains until they are a done deal. This rule is there to stop companies from inflating their profits based on wishful thinking. Okay, so this leads us to the critical question. How does a company actually decide if something is a full-blown provision or just a contingent liability? Well, it's not a guessing game. It all comes down to a really clear three-part test. For an issue to be recorded as a provision on the balance sheet, it has to clear all three of these hurdles. First, there has to be a real obligation today because of something that already happened. Second, it must be probable, and the standard defines that as more likely than not that the company is going to have to pay out cash or other resources. And finally, you have to be able to make a solid, reliable estimate of the cost. So you can really think of this as a strict checklist. If you fail step 1, or step 2, or step 3, if you can't tick all the boxes, you cannot create a provision, period. But that doesn't mean the problem just vanishes. Instead, it usually gets classified as a contingent liability, and the company has to describe it in the notes to the financial statements so investors are still in the loop about the risk. Now, you might be thinking that third step, making a reliable estimate, sounds a bit tricky when things are uncertain. And you're right, but IAS 37 actually gives us some guidance. In fact, the standard uses a perfect example with product warranties to show us how a company can calculate its best estimate. Let's walk through this. The company is basically using its past experience to predict the future. They figure, okay, 75% of our products will be totally fine, costing us $0. About 20% will have minor issues, costing us $1 million.
and a small 5% will have major defects costing $4 million. You see how they then multiply each cost by its probability? That gives you an expected value. You just add all those up, and bingo, you get $400,000. That's the amount they have to set aside as their provision for warranties.
So we've got the definitions, we've got the rules. Now let's zoom out and look at the big picture. Why does any of this really matter for the market? This table just nails a summary. A provision is a present obligation, the cash outflow is probable, so boom, it goes right onto the balance sheet as a liability. Contingencies, on the other hand, whether they're liabilities or assets, are only possible events, so they stay off the main balance sheet but have to be talked about in the notes. It's all about giving users the full story. So why do we care so much? Because these rules force companies to be more honest. They give investors a much clearer view of the actual risks a company is carrying. It makes it possible to compare apples to apples when you look at two different companies. And it stops shady practices like companies creating giant provisions in good years. They can dip into them to make bad years look better. It all comes down to building trust in the market.
And that really leaves us with one final thing to think about. Even with a super detailed rulebook like IAS 37, so much of this still comes down to human judgment. Estimating the odds of losing a lawsuit or putting a price tag on a future cleanup, these are not simple calculations. The rules give us the framework, but the real art of accounting is in how you apply them.